today's video, guys, we are going to be talking about market structure and pretty much everything you need to know about it to just help you get straight into it. So let's start with the first three different types. There you go, three different types of market structure. So what we have first is a bullish market, or known as a trending market. Okay, this can be bullish or bearish. So actually technically there's two types because this is technically trending market, and then consolidation would be this one, where you basically don't have any, obviously it's not going to be as clean as this, but you don't have any like real direction. So this will be your consolidating market, and then you have a bullish market and a bearish market. So these two are seen as trending. Okay, so these are trending markets, which is what you want to trade. This is good. Okay, and then this is your consolidation. Okay, so with these three as well, you can see here we are making higher lows and higher highs. Okay, so we have a higher high here from this previous whatever it would have been, and then a higher low, and then a higher high, higher low, high high. Okay, here we have lower low, lower high, lower low, lower high. Okay, consolidation, you have a whole load of everything. Not very clear. So if we come out here, let's see if we can find an example of both. I'm actually just going to, there we go, example of both. So here you can see we have a consolidating market. So there's no real direction here. We've just sort of chopped up and down. Let's see, here we go. Up, down, up, down, up, down, up, down, up, down. It's just like, there's no real direction, okay? And then before that, you can see we have here a nice down, down, up, down, up, down, up, down, up, down. So this is like a bearish market, clearly, right? We have a clear direction of what sort of like ideal aim for where we want to go is, okay? Moving on to time frame importance. So if for instance, we have a bearish market on the 4 hour, you can see we come up and we tap something in here. So this could be, I don't know, a fair value gap here, okay? Let's say this is a 4 hour fair value gap, okay? Whoops. There we go. So 4 hour fair value gap. Now inside of here, I'm just gonna do a quick, here we go. And then we're just gonna draw out a nice little circle. Okay, so inside of this point here, you will have on the lower time frames this. Okay, now what is this? Here, this is a market structure shift. So this is where you can tell that the market is going to potentially shift direction. Now this could be because we've hit this 4 hour. This, what makes this highly probable is because it hit the 4 hour, okay? So if we are bearish on the higher time frame and we are bullish on the lower time frame, you're expecting a trend change on the lower time frame to align with the higher time frame inside of a PD array, okay? And for this example, this is a 4 hour fair value gap. Okay, so we have the bearish PD array, we want to see it hit on a higher time frame, we then switch to a lower time frame. So in here, we're now bearish on the 1 hour, right? If this was the 1 hour, then the same can be applied for the 15 minutes. And the same for the 15 minute, it could also be applied for the 1 minute. So if you're looking to take your 1 minute entry, you're looking for first a confirmation of the 15 minute. So let's say you get this on the 15 minute, and then you're thinking, okay, cool. Now we're bearish. Now I have a 15 minute or a 5 minute fair value gap here, okay? So now you have a condition, right? So we've got a 15 minute. So if this now flips bearish, and we want this to see this definitely flip bearish, this 15 minute should hold, okay? So now we go down to the 1 minute. So using my model to teach this, what we might see inside of this 1 minute then is this. Okay, and ideally, if you're using my model, we will come up to the 15 minute and then we would have a nice 1 minute, say IFVG here. Okay, could be a 1 minute, could be higher, who knows? But let's say it's a 1 minute IFVG, right? So we've got 1 minute IFVG and now we're looking to go lower. So now the 1 minute is aligned with the 4 hour, so is the 15 minute, and so is the 1 hour. So the probability of this moving down is very, very significantly increased due to the alignment of all the time frames. Okay, so that is the importance of the higher time frame when it comes to, or like time frame importance when it comes to market structure. So I hope that's helped. So now I'm going to go into a bit more detail with market structure shifts. So some market structure shifts you can actually, first what we're going to do is actually go find an example of what I just showed you. So let's say we are bearish high time frame. You can see here we come up on the 1 hour. This is already tapped, but we do come up here anyway. So we come up to the 1 hour time frame here, and you see we have this 1 hour fair value gap we are respecting. We drop to the 15, find that. There we go, we have that market structure shift here, and then we look to get that 15 minute or that 1 minute entry or whatever it is, up to the 5 minute entry down below to go bearish, and we clearly respected this 15 minute. There we go. But then even if you go to the 1 minute, you can see in here if we were looking to take an entry from, if I can find it, here we go. From here, you see we come in, 15 minute respected, we get that 1 minute IFVG, and it plays out quite nicely. Okay, this probably would have been a break-even trade, but regardless, we would then have a bearish bias from here on out, targeting these lows. Some really nice liquidity actually here. This would have been a really nice trade. Yeah, so that is that. Now, yeah, going over the market structure shift importance. So you can have good versus bad market structure shifts. Okay, so let's say we have a good one and a bad one. I do apologize, my camera's wobbling. So good and bad. Okay, what is a bad market structure shift? Now, when you're looking for good versus bad market structure shifts, you want to be looking at displacement. Okay, so displacement is the key to all of this, right? Good displacement, good market structure shift. Bad displacement, bad market structure shift. Okay, what do I mean by this? What is displacement? So, bad market structure shift, we might be having an uptrend, and then we have this slight change here, and then we just rally up. Why did this fail? Because it could be seen as a sweep. So this might have actually been a sweep and faked a lot of traders out. Okay, so you would not want this. What you want is a nice strong move. So let's say we were in this uptrend like so, and then we have a strong down move. So this would mean that, you know, we've completely cleared this low. This could not be possibly a liquidity sweep. Sometimes it might be, but the probability of it being a liquidity sweep are highly unlikely compared to something like this. So yeah, that's the difference between that. Displacement is basically just how far the candle closes. That's another thing. You want to see a candle closure. So here we have our market structure shift here. Okay, this, let's say if this is a wick, right? So let's see if we can draw this out. So let's say this is this candle here, and then let's say this is the wick, right? So it's not a very good wick, but let's say this is the wick, right? So we basically barely. So if the candle body does not close below that previous low, that is not a very good market structure shift. You want to have the full body close to make sure that it is a nice strong movement down. So if you don't have that, you have that wicky, like potentially liquidity sweep, then this could potentially just come right back up, take you out. So you want to have that nice strong body close. Another thing, you also definitely want to have those market structure shifts within the time, within like a PD array. So you want to expect it to happen. So it has to make sense. There has to be narrative to your market structure shift. Okay, so you want to see this. Let's say this is the 15-minute time frame. You want to see this happen after, let's say, you hit a 1 hour. You're expecting a 1 hour, and then we get that market structure shift. Same goes with the 5 minute. If you're looking to reject from a 15-minute fair value gap, same thing. Okay, so that is pretty much that. Moving on, we have break of structure and CISD. Now CISD is basically the same as a market structure shift, but it's just slightly different in one way, and I'll tell you about that now. Okay, so a break of structure is simply a continuation of a trend. Very simple. Literally, this is your break of structure here. Okay. BOS, break of structure. Cool. Break of structure here and a break of structure here. Simple. Same applies with the market structure shift to the break of structure. You want to have a nice strong move up. People say you take half of the leg, but I think you don't really need that. You can probably just go to like here. It's just a nice strong move past it with a body close. If you're taking continuations of a trend, you really want to take those body close break structures, not the wicks. Personally, in my opinion, I've had not very great experience with just wick market structure shifts, so definitely use the bodies. And then a change in the state of delivery. Interesting. So it's basically market structure shift, but it is a body closure below the previous body instead. What I mean by this is if we go to the 15-minute, you can see these a lot. So your CISD would be the manipulation leg. Here we go. A closure from the manipulation leg. And here we go. So you see this, the last up close candle, we close above that, the close on the body, and then this is our CISD. So we come back into CISD, we clearly respect it. It takes us back up to here, and then we obviously move down. So yeah, you can anticipate that bullish move from there, if it makes sense, obviously. And then you have this one as well. This is probably a better one. So you have this manipulation leg here. That's another thing with market structure shift. You want to be looking to take the manipulation leg shift, okay? That is high probability. What I mean by that is manipulation leg could be this leg here, because it takes out all of this liquidity. So this is your manipulation leg. You get that change of state of delivery here. Price respects it. We push back down again. Not quite pushing all the way because we're probably bullish, but then yeah, so that one fails eventually. But as you can see, it respected it for a little bit. So here we have this manipulation leg here. This obviously being our manipulation, and then we change the state of delivery here, and then we respect it here, push up quite heavily from that, and yeah, that's the change of state of delivery. So I hope you guys learned something from this. If you are interested, I do have a premium Discord now, so it'd be nice to see some of your faces in there, and yeah, I hope you enjoyed the video.